Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. We're still in lockdown, but at Macro Hive we continue to publish and engage with our audience. Our Slack chat room is getting more active, so make sure to join in. And if you're not a subscriber yet, make sure to subscribe. It's only the cost of 1 or 2 McDonald's Big Mac meals a week. And remember, that's junk food while we're intellectual nutrition. Take your pick. We've had some great content out this week. Reflecting the uncertainty amongst investors, we had one piece by Dominic Dwyer-Foucault arguing for a lower VIX and hence continued rally in risk markets. Meanwhile, I wrote a piece that argued for more caution, especially around emerging markets. Last week's podcast guest, John Butler, published a note on how to trade commodities. And I also continue to delve into COVID statistics, this time looking at current hotspots around the world. Japan and Mexico stand out. We also featured some excellent summaries of academic work. One looked at how COVID case surprises are driving equity returns. So as the path of COVID becomes more certain, stocks react less to the virus. We had another piece looking at the path of inflation around natural disasters, which could share some similarities to today. On to this episode's guest, we have the global economist Phil Suttle. Phil is one of the economists I have always followed, and I think his daily is the best out there. I was lucky to work with him in my JP Morgan days. His credentials are impressive. He was at JP Morgan, where he was instrumental in creating the Global Data Watch, which continues to be published to this day. He's also worked at the Bank of England, Fed, World Bank, IIF, Barclays Capital, and Tudor, the hedge fund. Now he's an independent researcher at his own firm, Suttle Economics. So, on to our conversation. Maybe we could start with how you were seeing the world before COVID broke out. So we had a slowdown in the second half of last year, and it seemed like things were starting to stabilize. But how were you looking at the world before COVID?
Yeah, I think that's, if you look at it from a very narrow, short-term cyclical perspective, we were finally on the up going into the early part of 2020. And I think, there were two things going on. One was the sense that the US-China trade tensions had eased materially. And two, I think there were some favorable weather effects that were kind of helping us out in certain sectors, most obviously construction. So that kind of exaggerated a little bit the improvement. So I think we were on the up heading in. Having said that, I think there were, I had, basically I was projecting a 2021 recession. Obviously it came a lot earlier, but my concerns were twofold really. One was that we'd done sort of fundamental damage to the global economy through this shift to protectionism. So although we were getting a near-term relief bounce on that, fundamentally there was a problem looming because, this was not an issue that was going to go away. It was fundamentally damaging the business investment environment. And then on top of that, I was somewhat sort of out on a limb on this view. I just felt that we'd pushed too hard on the whole policy expansion standpoint. And in particular, we'd over-leveraged the corporate sector. We'd encouraged sort of irresponsible expansion, over-leverage in the corporate sector. And that was going to leave us vulnerable to some kind of shock. I had no idea that this sort of shock was coming, but at some point, some kind of shock was going to come to profits. And that would be a very negative event in terms of its impact on the system. So the going into this, as I say, the message was improvement in the short term, but some significant vulnerabilities.
Were there certain parts of the world that you felt before COVID were doing particularly well or relatively well, and others that you thought were doing particularly poorly coming into COVID?
Yeah, I think, again, the US and China, I think, were the two areas that showed most signs of improvement. In the context of the US, you had interest-sensitive sectors doing much better, in addition to the manufacturing and tradable sectors improving. So housing in particular was on a very good run. And, that has broader effects on things like consumer perceptions of well-being and wealth. China, I think, was kind of rebounding because of the trade improvements. Other parts of the world were doing less well, most obviously Europe, where, in the case of the UK, you've got the damage from Brexit. I think there was in my view, in the UK, there was a sort of false optimism that we settled the Brexit decision. The problem was we settled it in a way that I think was fundamentally growth negative. So that problem was playing out. And I think in Europe, on the continent, there was a continued issue with just the tensions of a poorly constructed EMU monetary union and how that was playing out.
So I guess then we've moved into the COVID regime now. In terms of the economic loss, how do you go about trying to calculate the loss in growth during this period?
Yeah, I mean, I guess my approach from a few weeks ago, in a sense, is to say, our traditional sort of demand side thinking of growth is not particularly helpful in this context. Ultimately, it's how some of these numbers are going to get calculated. But in terms of conceptualizing the hit, you're better off by focusing on the supply side. And, most economies, obviously modern economies, the big developed economies have very big service output relative to GDP and much smaller goods output. So in the US, for example, you're looking at services accounting for almost 80% of GDP and goods production, around 20%. So my approach has been to say, look, let's break quarterly GDP into a bunch of months, and different sectoral performance is affected month to month. And my working assumption has been that simply by looking out the window, that in the United States, for example, things were pretty normal through the early part of March, realistically to about the 15th or so of March. And then things fell off the edge. So I think what you've got there is a sort of projection for Q1 GDP that says project normal monthly growth of about 0.2 a month through the first 10 weeks of the quarter, and then make your best guess of how much the economy got shut down in the last 2 weeks of the quarter, and then make your best guess for how that will affect April and May. And when I do that, and these are kind of guesses as much as anything else, I end up with something like a down 7% annualized in Q1. And that's just because of the last 2 weeks of the quarter. And then I end up with something like a minus, getting ahead of myself, a minus 30% decline in the second quarter. And what I think is quite interesting is when I look at the way the consensus has evolved, it's pretty impressive how everyone seems to have come up with those same sort of numbers. I was looking at the Bloomberg consensus yesterday, and you look at the evolution of that. And so I think many of us are using the same approach. I wouldn't claim any originality, but I think, like great minds think alike, fools rarely differ. And I think that's the way economists are thinking about things. I think we need to be a bit careful about being too confident about this view, because in some countries there's a lot of kind of quirks to the way we calculate GDP, including a lot of imputed stuff. But we'll get our first test of this approach actually in just over a week's time, when the Chinese report their Q1 GDP. Because they're at least a month ahead of us in this whole process.
And what do you think about, like, something we've been doing is to look at these alternative data sets, like traffic data, airline traffic, rail, people's movements, or things like restaurant bookings. I mean, all of these, we're kind of all groping around trying to find anything that sort of measures statistics like that. What do you think of those sorts of approaches?
Yeah, I mean, obviously, in some sense, when you sort of write down your list of output-based measures, you can then sort of map from, your restaurant consumption variable or your restaurant output variable to, you can map into that from a report from, someone like Open Table or from another sort of data source, private data source. As I said earlier, I think there are some risks in doing that, because you're assuming that the variable as calculated by the private contributor is the same as the national accounts guys are going to end up with at the BLS, for example, in the US. So there are some sort of nerdy technical issues. I think we'll discover that we've made some horrendous errors when we get the actual data. And because the actual data themselves will be heavily imperfect and subject to substantial revision. So there's going to be a kind of fog of war effect here for an extended period. And, what Q1 and Q2 GDP end up being in 3 or 4 years' time is probably going to be quite different from where they first print. But I think there's no doubt we're going to get unprecedented. I mean, that's a word I keep using, but unprecedented economic data in the next few weeks. Because we know that because we've already had them. We've now had 3 weeks of literally off the charts jobless claims data.
Yeah, it's really quite phenomenal, some of those charts, just to see the vertical lines that we're seeing.
Yes. And I'd make one other point, Bilal, about the whole sort of big data issue, which is, frankly, I've been a bit disappointed. I mean, we came into all this, a lot of hype about big data and its ability to solve lots of global issues. And here's, one of the most obvious ways we could have used this very quickly, very early on, was in actually tracking COVID. And, I've been kind of disappointed in a way at seeing how poor the data coverage of this has been, especially through the official sector, through national agencies and international agencies. And right from the start, I've been using this Johns Hopkins spreadsheet. I think we've all been, website. I think we've all been kind of clued into that. And it's kind of a little disappointing that the authoritative source just happens to be a sort of university that jumped in there first and got ahead of the game. So I think, one takeaway from this is we probably need to be a little more thoughtful about our whole kind of big data approach to the world and monitoring.
I'd agree with that. My sense with sort of big data is it's been sort of directed to certain types of activities, whether it's high frequency trading or consumer behavior, those sorts of things. And strangely, they haven't been able to pivot so quickly to this outbreak. I would say there are some countries who have some quite impressive data. So if you look at Singapore's data on COVID, it's super impressive. It's quite, I'm not sure about sort of privacy issues, in terms of the level of detail they give in terms of addresses and so on. So there are some countries who have actually done quite well in terms of transparency. But it's surprising. You'd think that the US at least would be kind of off the charts in terms of how good the data would be.
But I think that point raises a very important issue, which is that the response of the East Asian economies and East Asian countries to this outbreak, which of course, it started there, has been so much better in some objective sense than in Europe and the United States. And I think the important point about that is the economic, at least the upfront economic costs and implications of it in East Asia are going to be far less severe than they are turning out to be in Europe and the United States.
I mean, in terms of precedents for this, I've seen there's been some work that's been done on past pandemics going back hundreds of years. We can look at the Spanish flu. There's some work I've been looking at recently about natural disasters, earthquakes, droughts, those sorts of things. But do you think there's any value in trying to benchmark this to historic events, or is it just so unusual that you can't really do much of that?
Well, there's always value in analogues. I'm a big believer that it's important to look at the past and learn from it. I worry that this one is, famous last words. This one is so different because it's not just obviously we've had plenty of pandemics in the past, but we've never had them in the context of such an integrated global economy. So that was what makes it, from an economic standpoint, so different. And the diffusion process through the economy was so much more rapid. But what's interesting to me is if you look at my forecast, which as I said earlier is probably the consensus these days, my forecast for US growth, and you put it in the context of the post-war period, it looks it looks extraordinary. You put it in the context of the interwar period, and it looks normal. This is, so I think one way of looking at it is we've returned to a world of and I'm not just talking about a few quarters in the 30s or the early 20s. I'm talking about the bulk of the period of the interwar period. You had as much volatility in US GDP growth on a regular basis as you're going to see, we think, over the next few quarters. And I think kind of what that's telling us is that COVID-19 has taken us back to a world where there's this smoothing role that policy was able to achieve after the Second World War. That smoothing role's disappeared. You can't blame policymakers for that, but it's a fascinating development where the ability of policymakers to kind of sit on the cycle and control it has at least temporarily been completely lost.
Yeah, that makes sense. Yeah, so I guess we're now sort of exposed to all the exogenous real shocks. We just have to take them, I guess, from an
Yeah,
economics
yeah. I mean,
perspective.
again, I don't think one should extrapolate this, for the next 5 years or anything like that. I think this will settle down. But I think it's a kind of, without getting too pretentious, it's a new world for volatility that I'm not sure that markets have fully adjusted to, if you see what I mean. Uh, and I think that particularly in the context of the equity market, that seems to be, still seems to have that very strong buy on dip mentality.
And you mentioned policy stimulus and smoothing and so on. What do you make of the policy response by everyone around the world so far?
Well, again, I mean, one of the most striking things to me, although it's changing a bit as we speak, is that how little the Asians have done, how little the East Asians have done. I mean, China doesn't operate its monetary policy in the same way that we in the West do, but they really haven't eased that much. In fact, if you look at a picture of Chinese monetary policy, they were easing much more in 2018 and 19, when the trade war was more of a drag. So that's one observation, and it's true across, East Asia more generally. Japan hasn't really changed interest rates, hasn't changed interest rates, hasn't really changed monetary policy a lot. And their fiscal package, which is just coming out, is still relatively modest. I mean, they try and talk big numbers, but it's relatively modest. So I think that's an interesting development that I think reflects this better handling of the outbreak. When it comes to sort of Europe and the US, I mean, I think you've got, in a sense, well, actually, it's probably best splitting the rest of the world into two pieces. There's what I would call the English-speaking world, that is increasingly doing the extreme things. And I think you could say, well, any kind of conventional economist is going to say, yes, you need to do a lot, do it quickly, do it aggressively. The problem with that strategy, works in the near term, but I think it has important medium-term implications that we need to think about. Maybe too early to think about them, but we need to bear them in mind. The other part of the world is the euro area. And there I think we have a major problem, which is simply that the imperfect monetary union I talked about earlier has been really exposed to have real issues here. And I, for one, have been always a bit cautious that you would see the survival of the euro in the long run. And I think this could be an event that could really, hasten its demise quite quickly.
That's interesting. When you look at the European situation, there's always these existential events that you sort of think with Europe that's going to break up. But when you look back at, say, 2012 to 2015, that period where Europe was really in crisis, whether it's from sovereign risk or from a growth shock, in the end, it seemed like even though Europe couldn't necessarily get its act together on the fiscal side, in the end, the ECB always stepped up to allow countries to essentially do whatever fiscal they wanted to. So don't you think we could just end up in something similar today, where the ECB effectively underwrites the sovereign bond market, so Italy can issue whatever it wants and then stimulate as much as it wants?
Yeah, no, it certainly can, and it is happening, simply put, in the near term. But I think there are sort of three implications or three new developments. One is that, the amount of extra debt that's going to get taken on as part of this is going to push, most importantly, Italy into an area that sort of takes it more towards where Greece was a few years ago. So it kind of raises questions, I think, about its Italian debt sustainability, debt serviceability, et cetera, et cetera. I think that's one problem. I think a second problem is that after all this settles down, I think the euro area is going to be much more fragmented. So we're going to have a lot more border controls. We're going to move away from greater integration, and that's going to be a problem in running a monetary union period. And then I think the third, and possibly the most damaging aspect of this, is just there's going to be a huge amount of bad blood. In a way, you can think of this as a make or break for the euro. If they can agree it could actually be the event that makes everything work. But if they don't, I think it could be the thing that makes, parties everywhere, not just in Italy or Germany, but everywhere say, hang on, this system just doesn't work for any of us.
On the Italian side, if you look at the current account balance there, I think it's in small surplus, I think, which suggests that, the country has some savings, which it can just allow it to fund itself. Almost like a Japan type dynamic where you have very large private sector savings that could just fund the public sector. Do you think that's a steady state outcome, or is that just...
No, absolutely. If everything else was fine, you have no issues there. But the problem is underlying Italian economic performance, which was already dreadful going into this and deteriorating further, and now has taken a significant, potentially at least a significant extra leg down. So, I think that's what will put the Italian, if you're looking at sort of the next 2 or 3 Italian elections, the idea that people will say, well, this system's really worth preserving. I think, each time it's pushed come to shove in recent years, the Italian population has said, yes, it is preserving, our wealth, et cetera, et cetera. I think this could be the event that really pushes us towards a mentality that says, heck, this isn't worth having. We'd rather go back to ourselves, to operating under our own system. I think the Italian, there's a lot of bitterness in Italy over stuff that happened in for example, the Greek bailout and the more general bailout, when they felt they ended up contributing and not getting much out of it. And I think this is the time when, I think the smart Europeans, hopefully the Germans, would say, we need actually to pull some risk here. And if they don't make that step in the next few weeks, I think that could have catastrophic longer-term effects on sentiment.
On this theme of how the world will look a few months down the line, or after COVID, you could say, one obviously is the euro area risks are fairly high. But more generally, how do you think the economy will differ after this COVID episode? What do you think will be different, if anything?
No, I think a lot will be different. And to me, there's 2 big things, and they're both negative, actually. I hate to say it. One is that, there will be a lot more anti-Chinese sentiment. I think there's inevitably going to be a sense of, these guys caused it. They gave us this. This is a problem. They were covert about it. I'm not saying any of this is justified, but I think especially in the United States, this sentiment will be quite powerful, and it will further intensify 2 things. One, a sense of breakup of global integration, global trade, et cetera, and it will kind of further the underlying US-China struggle, imperial struggle, whatever you might call it, that was going on anyway. You can't rule out some kind of military accident or anything like that. So I think that's a number one problem. That's an important problem. I think the second one, which you could say is more relevant in the near term, is that, as with the financial crisis, private sector behavior will fundamentally change. And in the financial crisis, what really happened was that the financial system, especially the banks, became very, very conservative. And that effect was compounded by regulation. And it had a very dampening effect on the expansion, the subsequent expansion. This time around, I'd expect that effect to go more general. And I'd expect more cautious behavior to become part of the non-financial private sector as well. So you'll see a lot more buffers established, less debt, more equity, fewer buybacks, etc. But also just a lot more of a sense of cautious behavior. More inventory held, less globalization, less travel, less integration. And I think that behavior is going to kind of reset the global economy at a more cautious and probably therefore lower level. The final point I should throw in here, actually, which is something that doesn't get a lot of discussion in the context of the world we inhabit, is the negative effect it could have on the emerging world, and not just the higher income emerging economies, but everyone down the spectrum. And that could have setting the world's poverty level back down a few notches could have a very negative effect on many things, including, global geopolitical stability.
How do you see all the government and policy interventions managing all of this? So in Europe, you have lots of programs to incentivize companies to retain staff. You have credit guarantees in the US. All of these kind of measures to try to minimize the sort of hysteresis, you could say, in the labor market. Do you think those sorts of things will make a difference?
Yeah, I think they'll help, but the problem again is one of where does it leave the system after you've got through all this? You're essentially then you've got an economic system with more dependence upon the government for employment guarantees, for in some cases direct employment. You've got much higher debt levels in a world, government debt levels in a world where there were already very significant government debt level issues and problems of demographics leading to further deterioration in coming years and decades. So I think one of the tensions here is that we're headed. I mean, there was a lot of talk going into 2020 about Japanification everywhere, and I guess one of my quips was always, we'd be lucky if we end up as well as Japan in this context. I kind of think that's beginning to play out. So I mean, one way of thinking about this is we've got two broad options ahead of us. We've got extended financial repression, where we end up with higher government debt, but much lower interest rates to serve, because that's what's consistent with it being serviced. And I think that's the route we've already gone down in many ways for the last decade, and we're certainly going to start down that route more aggressively in the decade ahead. The alternative is we actually end up with something that's much more of a solution in the short term, maybe an ugly solution, but is higher inflation. If you think about how wartime debt levels get eroded, in most cases it's because you end the war with a nice bout of inflation, and it resets debt levels lower. And I suspect we could be looking at that across many developing countries over the next decade or so. Not the next year or two, but over the next decade. Because in one sense, we're actually perfectly set up for that type of inflation tax. Because as you're well aware, the key to that working is it must be unanticipated. Where inflation's anticipated, you can't use it as a tax. But when it's unanticipated, it works really well. So in some ways, we've got all the setup conditions for it, and we just need it. We just need to find the kind of match that can light the inflation tax and get it working.
And how do you see the inflation path, say in the developed world, say in the US or in Western Europe, in the coming quarters?
Yeah, I mean, it's a cute dynamic. I mean, I think we're inevitably heading lower on headline inflation. We're already clearly heading lower because of the impact of oil. But what I'm arguing, if you look into the next sort of 3, 4, 5 years, there'll be tensions developing. And they aren't necessarily sort of, output gap type relationships. They're more just, this is a way to square all the claims on the system, to have higher inflation. It isn't a desirable outcome. It's not a controllable outcome. It's certainly not a good one, but it may just be the way you make everything add up. And we talked earlier about historical analogs of pandemics, et cetera, et cetera. I mean, I'm using, in a sense, one of the most conventional historical analogs, which is a world where, you've created too much government debt, and you need to get it down. And historically, and we're not just talking about the Zimbabwe's or the Argentinas. We're talking about all the major economies. Historically, the way to get government debt down to more manageable levels is through inflation.
Yeah, that makes sense. I mean, that's kind of the oldest trick in the book for governments to do, especially around wartime. So
yeah, and I think we economists tend to sort of assume it's a sort of deliberate policy ploy, etc. Actually, that's the way the system reconciles itself to a new equilibrium. And it's very hard sitting here today figuring out, okay, what is going to be that spark that's going to tick us up? And I think the way I would look at it is the way it will play out is that we'll gradually see an uptick in inflation as normalization occurs, and the supply side damage that we've done begins to be more important because, we shift the demand curve back out and we don't have the supply elasticity that we once had. And that begins to set off a process that then takes you into higher inflation expectations. And that begins this kind of process of acceleration.
No, I hear you there. I mean, one potential positive scenario post-COVID could be a increase in investment, particularly from the public sector. I mean, do you think that's something that, people often talk about, we need more infrastructure spending to get out of secular stagnation. There was all these kind of arguments that would be made before COVID. Given the level of state intervention now, do you think that's something that could be a potential silver lining through all of this, or does that not work?
Yeah, it could. It definitely could. My worry about, when I look at the developed market economies, what they've consistently done over the last decade at least, and it's accelerated since the financial crisis, is substitute higher current spending for capital spending, because there's a population to keep happy, and in the United States, it's an increasingly aging population. And I think everything we've been talking about says actually that burden of current support spending is going to go up in the next few years, not go down. Now you can say, well, there's enough potential to increase government debt that we can do both. We can increase capex and current spending, especially if we keep interest rates at zero, as that takes that component of spending way down. But I would worry that that's a very optimistic scenario. I think we will get infrastructure. We'll certainly be getting it in some countries like the UK, where they're pre-COVID there was a plan to do more. The United States has this major problem of the federal versus state system. States do most of the infrastructure, and their finances are going to get shot through by COVID. Not necessarily every state, but many states in the union are going to find, many states and municipalities are going to find themselves in real financial problems over the next year or two. So they're actually going to be cutting infrastructure and capital spending.
And in terms of the trajectory for this year, you have a hit to growth in Q1, Q2, then a recovery in the second half. The recovery in the second half, is that just almost a mechanical output?
Yeah, no, I think the most important factor is, what I would call normalization. In other words, we're allowed to go out and we go back to work, and that process, produces a reset of output and income levels back towards where they were pre-crisis, and towards, not to where they were. So there is a medium term or a 6 month, 9 month loss in the level of income and output relative to where we were in January, February. But if you my expectation, again, it depends which part of the world you're in, but in the United States, my expectation is the low in the economy will be the first half of April. In other words, where we are now. Second half, I think you'll see some improvement. Maybe that's too optimistic. May, more improvement. By the end of May, I'm looking for sort of, I wouldn't call it full normalization, but getting back towards the sort of levels that China is at as of today. Europe probably following the same dynamic, maybe slightly earlier, because Europe's kind of went in first and has been a bit more aggressive. So when you kind of, again, map that into this kind of monthly pattern, you end up with a picture that says, the June starting level of output is going to be massively higher relative to where we are today in the first half of April. And I'd say something like a 30% annualized gain. Now, down 30, up 30 leaves us lower in levels. And then I'd be a little nervous, certainly in some countries, in the US included, that the fourth quarter may fade a little bit again because of the sort of second round effects on employment, i.e. high unemployment, and corporate leverage, corporate debt. At that point, I think some of the sort of elastoplast covering that the Fed's put on to kind of hold the system together may be kind of peeling off, and we start seeing more corporate insolvency, for example. So I think if you look at it through the prism, through the lens of the specific numbers, it looks like a very strong recovery. It looks like a V, unambiguously a V. But if you think about it in the context of the broader business cycle, I think the idea that we're going to get a rapid recovery and that by the end of the year we've kind of forgotten all about it is clearly, I think, way too optimistic a view.
Maybe just another question I wanted to throw at you, rather than views. During this sort of COVID period, in what way has your analysis changed, or the way you look at the world has changed?
Well, I suppose the most significant way I've had to change things is I'm one of these people that thinks that your best way of doing economic analysis is to just track the evolving data. So you can actually, it's very hard to have a high conviction on where we're going to be in 3 or 6 months. We all pretend we have it. We all pretend that we can do it. But reality is, your best way of analyzing the situation is to just, it's a bit like driving a car. Keep your eye on the road and make sure all those bends that you're just approaching, you can see them, you're mindful of them, and you're factoring that into your thinking. That's the sort of data watching approach that I've had for about 35 years. We were colleagues at JP Morgan, and that's the sad to say, I'm a one-trick pony, and that's the way to do it. Now, unfortunately, that world has changed a bit. In other words, I think what I've realized is, in a very obvious way, looking at current data releases. Take the German current data releases from Germany. They are fantastic. German IP yesterday for February was up, 9% annualized or something over Q4. Germany's booming. Well, obviously it isn't. So you have to, kind of, I think, step back and say, okay, what data can I process, and how do I process it, and what data do I know must be out there but I can't yet see? And we talked earlier about some of these private sector surveys. But even those, you're sampling from a universe of activity that is just so unusual that any particular sample you may take may be highly tainted or contaminated or biased. So I think that's the challenge that I've found, is how do you, my image of doing economic analysis is you're always trying to describe a picture to the relevant user of your work, investor or trader or, whatever policymaker. And that picture is continually changing. It's always imperfect and it's continually changing. The problem now is that, it's like someone pulled the cable plug out, and then the picture's gone. And now you're really trying to guess intelligently as to how things, will evolve. And in that context, also trying to get yourself kind of anchored in discipline of, okay, how do I interpret this information? What if I have jobless claims at 6.1 million each week? What's that really telling me? So I think that to me has been the main challenge in the way I do things. Obviously everyone else in the world has had very, in the economic analytical world has had very many other challenges. Maybe to take my point and apply it to our industry, we've seen the development of a lot of quant models. Both to forecast, to trade, to run portfolios, etc., etc. Those, talk about disturbance. Those obviously have been completely thrown up in the air. And I think, it will radically change our industry in that sense, not just in terms of where the asset markets are going.
Yeah, no, I agree. I have to say your daily, I think, is one of the best dailies around, and I've been following it for many, many years in your various institutions you've been attached to and during your current independent phase. So I'm a big fan of your approach.
Well, as I say, I'm a one-trick pony. That's the way to think. I urge anyone out there who's sort of thinking about how to do stuff. Find your niche and focus on it rather than try and do what everyone else is doing, sort of thing.
Now, we could go on and on and on, but I think this is probably a good point to end our conversation. But just for the benefit of our audience, what's the best way for people to be able to follow your work?
Well, I'm as you said earlier, I'm kind of doing my independent stuff these days, and it's suttleeconomics.com is my website. We have a subscriber list that I'm happy to add you to if you wish. Anyone listening, it's phil@suttleeconomics.com, phil@suttleeconomics.com. I apologize for having such a boring name. When I started, I'm not as smart as you, Bilal, so I couldn't come up with the image of a macro hive or something like that. So I ended up using my name in economics, which is about as crass as you can get, but at least you understand who it is and what I do. So yeah, I'm eager to kind of connect with people and love interaction. So
great. I'll include the details as well in the show notes attached to the podcast as well. So with that, thank you very much, Phil. I really enjoyed the conversation.
Thanks a lot. That was terrific. And good luck with everything and stay safe. And to everyone out there, anyone listening, please also stay safe and be healthy and happy and successful in the coming V-shaped rebound.
Great. Thanks a lot. Thanks for listening to this episode. Please subscribe to Macro Hive Conversations on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show too. Also, sign up to become a member or subscriber to our research at macrohive.com. We'll be back soon, so tune in then.